We have Sanjeev Prasad now joining us, Managing Director, Co-Head at Kotak Instl Equities, to take some questions. Sanjeev, good morning. It's always a pleasure having you with us here on the program. The global narrative, which you've highlighted in past interactions, is perhaps a potential headwind down the line. That headwind is receding. At least it seems like that at this point in time. Bond deals have come off. The dollar has crashed over the last just 5 or 6 days. How are things looking as you look at prospects for the market near to medium term here?
There are two parts, Prashant, over here. One is what's happening on the bond yield part. So as far as the macroeconomic situation is concerned, people are assuming there will be some, pause as far as rates are concerned for rate increase are concerned to central banks going forward. US Fed will probably do one more round in July, and that's about it. So that is something which is getting priced in currently. What is not getting priced in, I guess, is what could be the impact of all the rate increases which the central banks have taken over a period of time on the economic activity. If you look at the US in particular, economic activity continues to be fairly robust, which means the US Fed has no option but, I guess, to keep rates at a higher level for a longish period of time. So what does it do to economic activity over a period of time and earnings numbers, etc.? That will play out. So as of now, the market is more focused on the first part, which is speaking of inflation and interest rates, and not that much focused, I guess, on the negative part, which could play out over the next 6 months in terms of lower economic activity.
Okay. How are you feeling now, Sanjeev, about the IT space? It's come back after a while. The earnings were not great. I mean, the management commentary was also cautious for a lot of these big tech companies. But prices have come back. What's your view?
I don't know. I mean, honestly, the reaction was a bit of a surprise. I guess somewhere the feeling is that what's in the stock price in terms of 1Q FY24 results being probably the bottom in terms of disappointments in terms of either top line or profitability. And from here on, things would improve. I'm not sure how that will exactly happen because so far we haven't really seen a big global slowdown. There has only been talk of a slowdown, but no real slowdown for whatever reasons. And actually, a second half slowdown is there, which we assume will be the case as far as global economic activity is concerned. I'm not very sure you will suddenly see a big pickup in discretionary spending by the IT sector, the consumers of the IT services companies. So I think this still has to play out in terms of probably more earning downgrades going forward.
Hi, Sanjeev. Good morning. Sanjeev, we are tracking the flows and they've been rock solid with regard to the hot money that's coming, the FI flows. The DIs was taking some money off the table. But I wanted to ask you, what are you making of this promoter selling? I think the past couple of months, we have seen the highest amount of promoter selling. Is it a cause of worry that could be viewed negatively? Or do you think the depth of the market is such that you're getting good quality investors that are coming in, that good quality institutions that want to be part of companies, and you would actually view it positively?
The insiders are selling, you need to be careful here. I mean, they are probably are the ones who know the best about their companies, and we have seen a lot of selling by promoters, PE, entities, and so on and so forth. So I guess the mood of the market is very, very bullish as of now. And looking at the valuation, some of the promoters themselves will be taking a call, to reduce their position. I'm a bit surprised because normally, promoters should be holding on to their stocks forever. But if they are taking a call that the valuations are too high, I really don't want to argue against that. The market may have its own, take on this. But if promoters are selling, you need to be careful, I would assume. Unless until it's something to do with, minimum public shareholding, or if the company has to bring it down to 70%, that's a separate issue. But if that's not the case and the promoters are selling, then I guess, they themselves may not be finding too much value in the company at this point in time.
Got that. Sanjeev, from here on, what changes should one make? I mean, recalibrating IT, for example, would you say that buying a IT-B's kind of product make sense from here? IT services, you think that is still... people have been waiting for this US recession for a while and how it will hurt growth for especially large cap IT. Mid cap and small cap IT has done very well. What's your sense?
No, I would continue to be underweight on IT. Look, if you look at the US, as I was saying, the economic activity is still very high, and the reasons for that. So if you look at the households, for example, their consumption is not really slowing down. Household debt is actually fairly manageable over there. There is no real impact of higher interest rates on household debt or repayment, for the simple reason most of the debt related to mortgage is at a much lower level. So there is no real impact of higher interest rates on consumption as yet. Number two, households sitting on a huge amount of excess financial savings because last 3 years we had a lot of financial giveaway by the US government. All that will start running down by September from whatever calculation we have done. Then you had a lot of debt forgiveness or debt postponement, repayment postponement of student loans, etc. Even that will start coming back going forward. So if I put all this together, I suspect the US consumption, which is still holding up reasonably well, and also there's one more factor, by the way. You've also had fairly stiff increases in wages. So it's not as if the households are feeling the pinch of a higher inflation. So over time, as some of these positive factors start fading out, US consumption has to slow down, in my view. Parts of it is slowing down, the more the household new house purchases, for example, but the consumption part is still holding up reasonably strong based on the factor which I highlighted. So as and when things actually start slowing down the US, I would suppose, companies would be a lot more careful about, what kind of spending they want to get into when the US is actually slowing down or, God forbid, even going into a recession. So let's see how things pan out. I would be a bit cautious on IT at this point in time.
Okay, cautious on IT, but I don't think the market is cautious on IT. Just look at that. Barring TCS, all IT stocks are trending in the green right now. And the Nifty IT index, in fact, this month is up almost 5%. So, that's been the kind of rally. By the way, lots happening in Route Mobile. As you can see, the promoter is looking to sell its entire stake, stake representing about 57%. So, Route Mobile, is the stock in focus right now, 6.5% higher. We'll get more details on that. But in the meantime, I also wanted your thoughts, Sanjeev, on what's happening with some of these spaces that have rallied hard this year, which is, spaces like autos. Is there more upsides here in names like, say, an M&M or a Bajaj Auto, which have already rallied about 25-30%? And if not, how do you approach that space now?
Not much, Sonia, to be honest with you. All the stocks have rallied on expectations of big improvement in profitability going forward, which will happen. Obviously, you have seen a big decline in raw materials, whether it is metal, plastic, rubber, everything. Prices have come off pretty sharply in the second half of FY23. So based on that, you have seen a reasonably big jump in 4Q FY23 gross margin, EBITDA margin. That will sustain in first half of FY24. But having said that, the volume numbers are absolutely disastrous for just about every auto company, barring M&M and Tata Motors passenger vehicle volumes. If you look at on a 4-year CAGR basis, in most cases, volumes are flat or down significantly, even down 8-9% 4-year CAGR, which is like something like 40-50% down compared to 2019 levels. So I'm not very sure, whether I should be playing the shorter term improvement in profitability or worrying about volumes. And more important, there is a lot of disruption coming in the sector going forward. And the multiples really don't factor any sort of disruption which is coming in, whether it is the two-wheeler space, more competition coming in from the EV side, or whether the four-wheeler space, same problem over there. So if you have a combination of, somewhat muted demand, more competition coming in, and companies sitting on very high profitability, profit pools, I think they're all ready for disruption. They will all decline going forward, and multiples will, come off very sharply from where they are. So autos are a strict no-no for me at this point in time.
Okay. All right. Sanjeev, we'll leave it at that. Thanks a lot for joining in.